first rates any seconds on your screen now. 28 points higher for Nifty. For the Sensex, it's again an uptick of nearly 0.25%. So it's a strong start, but the market breadth, I think, is where things are looking up. The market breadth, let me put it this way, it's a ratio of about 1:5, and that's always a very formidable ratio, which means that the broader market is throbbing. The small and the mid caps stocks, in a sense, are really rediscovering a lot of momentum. Not too many newsmakers, but let's start with Zomato. Why? Because Swiggy valuations have been cut. There's a markdown for Swiggy's valuations, but Zomato stock is not seeing an impact because Zomato has already seen a markdown in terms of valuation. So this is not something new. Then let's move our attention to some of the banking stocks, and especially NBFCs actually. Bajaj Finance, Aditya Birla Finance, Indostar. The entire NBFC space now seems to be making a comeback now that interest rates have picked up. So Bajaj Finance, AB Capital, you've got L&T Finance, that Mahindra Finance, that entire space now is throbbing with a lot of action. Look at HDFC Bank and IndusInd Bank. IndusInd Bank recovered, will it sustain? HDFC Bank, is that entire MSCI overflow hang, is that behind us? Hopefully for the moment it's settling.
Yeah, it is. Just a couple of other stocks which are going to be in focus. In MGL, definitely, the Q4 EBITDA has come in over 52% on a sequential basis, and the margins as well have managed to beat the street estimates. In fact, it's a big beat. We're seeing MGL gap up right now, 5.25% higher for MGL as we speak. VIP as well has come out with good numbers. The gross margins have managed to expand about almost 460 basis points on a year-on-year basis. And then, of course, there are others like a Birlasoft as well, wherein the dollar revenue has risen about 0.5% sequentially, and the constant currency revenue has been higher, over 3%. Birlasoft, very actively traded stock, must say, 3% higher on Birlasoft as we speak. Kansai Nerolac as well came out with its numbers, a bonus issue, margin expansion of 420 basis points, 8% is the move that you're seeing on Kansai Nerolac. Of course, we've been seeing the crude sensitives as well hold out very well, and this further aids the move on Kansai Nerolac, which has gapped up 8% as we speak right now. Pidilite came out with numbers though. Those numbers are not looking all that great. The consumer durable business volumes have come in higher by 7%, but they've managed to miss the street estimates. The Q4 results are clearly below what the market was anticipating and penciling in. Pidilite down 1% as we speak right now. Aarti Industries, Kalpataru Power, all have been an earnings miss. Let's also check in on what Marico is up to and whether it's seeing a further move, whether you're still seeing a move on a Manappuram, or for that matter on an IndusInd Bank as well. Those stocks will just come up here on the screens. Marico sees some bit of buoyancy more, Manappuram rebounds further, and IndusInd holds out by 0.8%. What are the HDFC twins doing? Yesterday, of course, they saw a marked recovery, and today it's a much more tempered move, flattish at that, marginally higher. For the index as well, it's fairly tempered, but the headline number is not going to give you any reason to complain. We're marginally higher, but Kunal, on the spot now, we've made it to 18,300.
Yeah, I think it's a good comeback for the index because what the SGX was actually showing a muted start, but then if it's on the positive side, it just adds to more positive booster for individual stocks. The stock I would, which I would look to trade in the open would be Glenmark Pharma. Looks very attractive as a setup, trading at 570, which is already a fresh swing high for Glenmark on the short-term charts. Looks very attractive on the short-term time scale.
Glenmark Pharma, that's what Kunal is picking out. Just taking a look at the screen then, Naresh, the fact that we're holding out comfortably in the green around the 18,300 mark, where are you sensing opportunity?
Considered like Axis Bank, that is a stock which can take leadership in the banking space going forward. So expecting that to be a leader. So still an accumulated current levels and more on the way up at 900.
All right. Mark Matthew joins us now. Let's take a conversation forward. Mark, good morning. Thank you for joining us. Mark, there seems to be a change of heart or a tactical positioning change, but suddenly India is a large recipient of FI flows. Earlier this year, the challenge was that lot of FIs had migrated from India to China. Looks like they are making a comeback to India.
I guess so. I guess that if I had to identify a reason for the fund flows, it would be that the foreign investors are becoming lukewarm on China. They played the recovery, and now they're thinking that the recovery is done, and so they're looking for other places to invest in. I might add that Japan has also been a recipient of a lot of foreign interest over the last month or so, and it's a similar story.
Reward ratio for equities now that we've seen a sizable comeback in across the board equity as an asset class?
I didn't know there was a question. I'm sorry.
No, my question is, where do you see the risk reward ratio for equity as an asset class, considering that we've seen a sizable comeback?
I mean, I think it's fine. I think that foreigners are underinvested in India, and it has double-digit earnings growth, and it's had a year and a half to digest higher valuations, so it is not expensive anymore. And if you think that the Federal Reserve has finished raising rates, whereas the European Central Bank has probably got some more to go, and that means the dollar should be softer, then I think it all adds up to a positive backdrop.
Mark, so are we in for rest of the year? Are we in for more gains for equities in general and India in particular, or this is as good as it gets for 2023?
We think the market will go higher through the summer, and maybe a little correction in the third quarter as people fret about the possibility of a recession, which is not immaterial. But if there is a recession, it'll be one of those recessions that you hardly even feel. In other words, maybe a couple of quarters of a very mild contraction. But if there's still about 3 or 4% inflation in the United States, then you'll get earnings growth despite a slight GDP deceleration for the S&P. And so anyway, going into the end of the year, we'd also look for a rally. I would say one thing. If you look at the last 10 rate hike cycles, going back to 1974, and what did the S&P do after the last rate hike of those rate hike cycles, then actually on average it was down a tiny bit over the next month. But then it was up a little bit over the next 3 months. It was up about 5% over the next 6 months on average, and it was up 14% on average 12 months out. So at least historically, the evidence suggests that the end of a interest rate hiking cycle is a positive thing for the stock market.
Mark, that entire move money out of India, put it into China, India versus China trade, you think has come to a halt? I mean, because both the markets can coexist and do well, right?
Yes, they can, especially because, to my mind, the most important ingredient is the domestic money. And in both countries, it's much bigger than the foreign money that could be invested in them. So I think they can coexist positively in terms of going up at the same time. But to my earlier point, I would say that the one market in Asia that does seem to be attracting the most attention is Japan. And it is a much larger market, of course, than India. It's the third largest market in the world, so it's very deep and liquid, and it's a developed market. And Warren Buffett announced last month that he was increasing his stake in the 5 big trading companies there, and he visited the country as well, which is quite rare for him to go overseas. So I think India can do just fine, will do just fine, but foreigners seem to be more interested in Japan, looking for alternatives to China at the moment.
Mark, hi, morning. What is the outlook then in terms of the approach? Is it time then to buy equities, you think, at the current juncture from a long-term perspective?
Yes, it is. Certainly, if you don't own any, because they do go up over time. And as for the trading aspect of it, I wouldn't venture a guess because there's so many different things that happen that can cause markets to go up and down on a weekly basis. But you know, what is kind of interesting when you think about it is if you could rewind the clock and put yourself back at the beginning of the year and know all of the crazy things that have happened between then and now, like the Federal Reserve kept raising rates a lot, and you had a Credit Suisse in Switzerland, and Silicon Valley Bank, and First Republic Bank in the United States, and yet, you know, the S&P is up 9%, including dividends so far this year. So I never feel that trading the market based on news flow is a recipe to make money. And just stay invested. And over time, if you're invested in good quality companies, they will go up. Most of the companies, at least by market cap, that comprise the Nifty index are good quality companies.
Mark, when it comes to India, one is seeing a tactical shift. While people continue to be bullish on financials and especially banks, but more money is now migrating to manufacturing and more inward looking because there isn't much investment here. It's more domestic manufacturing which is getting a fillip. Do you also believe that people are right about this trade?
I don't know if I can comment on that trend. I don't know why it would be happening. It certainly makes sense to me that manufacturing as a percent of the economy grows in India. We can see the infrastructure that's been put in place to accommodate industry. And any other country in the world where you've had so much investment in ports and airports and roads and electricity, et cetera, a natural corollary of that is in growth in the industrial sector. And Tim Cook visiting the country and saying he has a positive outlook on it as well. It all fits. But is that the reason why people have been buying industrial stocks, manufacturing stocks recently? I don't know.
Mark, so if you have to park your capital or your money in just two asset classes, one long and one short for rest of the year or for next 12 months, where will you go short? And where will you go long?
I can't think of many places where I see prices really deserving to go down a lot, because the ones that were extremely overvalued, say a year ago, they deflated quite significantly. I think we're not recommending something like a cryptocurrency. Or I don't know what, but anyway, no, I don't see anything to be very short against right now. And broadly speaking, I think financial assets will continue their road higher, especially given that interest rates have peaked in the United States.
Mark, I can understand why gold is going higher, but what I cannot understand, and I really want to understand, and please help me understand, is why Bitcoin is going up.
I don't understand either, but I would just say that Bitcoin tends to be viewed as a alternative currency, isn't it? And so if you feel the dollar is going to continue to go down, then you should think that Bitcoin is the inverse of that. I don't really know what else to say apart from that. It's considered a bit like a digital gold, if you will. So people buy it when they think the dollar is going to go down.
We all are trying to understand, aren't we? We all are trying to understand that what is the mystery why Bitcoin and crypto is going higher. Warren Buffett at the Berkshire AGM did indicate that US dollar is unlikely to lose its status of a reserve currency because there are no alternatives. If that is the underlying thought that the US dollar is unlikely to lose its status as a reverse currency, what implications do you think it will have on the dollar index and then on emerging market currencies?
Well, the dollar has been the world's reserve currency for many decades, and yet during those decades, it's not been a one-way street. It's gone up and down like a yo-yo. So I don't think the reserve currency status of the dollar by definition determines where it's going to go. And so there are two functions of a reserve currency primarily. One is a store of value, one is a medium of exchange. And as a medium of exchange, one could say that it's probably peaked and going to go down because more and more countries are saying they're just going to trade amongst themselves. But ultimately, I don't think Brazilian companies, for example, want to keep a lot of renminbi. What are they going to do with that money? They probably will end up putting it in dollars. And as a store of value, well, there just really aren't enough alternatives, which probably explains why gold is going up, because there's no yield in Japanese bonds. There's China's currency is a controlled currency, and the bond market there's not much transparency, so you don't really know what you're holding. I don't think anybody has a great deal of interest in owning lots and lots of euros. And then you've got some smaller currencies that are quite decent, like the Australian dollar or the Canadian dollar, but you can't own loads and loads of them. So anyway, I don't want to ramble, but I do think probably as a medium of exchange, the dollar's importance is going to gradually decline, but don't think that will be a big factor in determining where the dollar goes. The most important factor is where the Americans are in the interest rate cycle versus the Europeans. And there, I do think there is reason for the dollar to go down because Americans aren't going to raise any rates more, and the Europeans will probably raise rates by another 75 basis points from here.
Really appreciate it. I'm so glad you could join us. You know, Aisha Awan, there was a very nice article from Ruchir Sharma, I think 2 weeks ago, where he talks about the dollar decline. And he's made some great points. He says, look, you must understand that why dollar is in a decline. Because global central bankers, let's say RBI, when they get forex reserve, where do you park your forex reserves? You would be parking that in dollar because that was the safe haven. Now you're parking into gold. That's a global phenomenon where central bankers now parking their surplus kitty into gold. Second, the non-dollar trade has started. India is buying oil from Russia. It's a rupee transaction. There is no dollar involved. A lot of countries have started using local currency. I mean, from our neighboring countries, we are actually now using rupee as the basic, currency for trade. And third, America has put sanctions on almost 1/3 of the world. They've got sanctions which are directly and indirectly on 1/3 of the world. They will not transact in rupee with you. Like Russia is under is sanctioned. I think Iraq has certain sanctions. Some African countries have it. Some Asian countries have it. So 1/3 of the world is not going to be transacting in the dollar currency. So bottom line is that Ruchir feels that the era of the king dollar is over. It's a great thought, actually.
Although Warren Buffett said that he doesn't see
He's
a
an American.
replacement.
He's an American. Please realize that there's a bias
to
which
the
is
US
there.
dollar. Absolutely. Let's welcome on board Satyanarayan Raju, the MD and CEO at Canara Bank, talk about their numbers. Mr. Narayan, great to have you on the show. You've guided for a loan growth of 10% in an environment where the system is growing at 15% plus. You are well capitalized with a good CD ratio. Why not aim to grow more aggressively?
The last year, when you look at that, our guidance to the market was around 8.3%. Whereas, so we have grown a double-digit growth. Even a domestic credit has grown around 15%. The same thing this year also we reflect in our working. We have taken that guidance is based on that various factors and all those things. It's a minimum. What we projected is only a barest minimum of 10.5%. But when it comes for the reality and the results, definitely we are confident that the growth will be much better.
Right. You're growing at 20% plus in agri as well as the corporate segments. Would you continue to see strong opportunities there or look for stronger growth in retail, say, in this fiscal?
Retail, actually, we are looking at a much better growth in the current financial year. Our housing loan has grown at 14.6%. But overall, with the push of the housing loan only, our retail has grown at a double digit. But this time, we are focused on not only the housing loan, various other products of retail, like a vehicle loan, educational loan, and a personal loan. There is a under budget scheme also we have introduced. We initiated several new initiatives to attract the customers. We have brought our pricing and various other onboarding features at par with the market, and we are going very aggressively on that. And we look forward for from the 10.9 to around 13 to 14% growth in the retail growth. So that's the growth rate what we are looking at this year. And agriculture and corporate, the strength is our strength is that, and it will continue to grow beyond our expectations only. The last year, if you look at the corporate, our corporate growth domestically, if you look at it, it is around 17%. When you look include the overseas exposure, that's across 20% because of that some oil companies exposure for short-term loan. But the domestically we have grown around 17 to 18%. This time also we are seeing the same traction. First last 1 month we had already several committee meetings for sanctions. We have communicated several sanctions. We are seeing a lot of traction there. And agriculture and allied activities, since the 59% of our outlets, branch outlets, are located in rural and semi-urban, that's the strong base of the Canara Bank, and we continue to perform there the same rates, approximately.
Interest expenses have gone faster than the interest income in Q4. Despite that, you expect NIMs to rise in FY24. What gives you this confidence?
The reason is, one is the deposit side, one is an asset side, sir. The deposit side, the term deposits, whatever it has done, when the interest rate regime is the highest interest rate regime, the customer depositor will have an option to switch over to the new interest rate or the next day itself. There is no bar that he has to continue with his existing contract. He can prematurely close, he can reinvest his money in the higher yielding deposit receipts. Accordingly, that's based on that comfort of the depositors. So depositors in our bank also, generally more than 90% of deposits are less than 1 year. 1 year and 1 year bucket only, the deposits are there. These deposits, 90% of these deposits already been repriced and the higher rate of interest, either it is 666 or it is a 400 scheme or it's a the 444 scheme. So there, the chances of again increase in the interest rates, the deposits, is a very limited chance. So whatever this entire quarter we have seen that the interest expenses, it has reached to a peak level. So it may continue at that level unless otherwise the market is comes down in that rate of interest. But when it comes for that assets, asset side, our 49% of total loan book is under MCLR. This MCLR loan book will be resetting only on a majority on annual basis. So still a 40% of this 49%, that's approximately 1.5 lakh to 1,60,000 crores, will come to us for resetting at a higher price. So that is a cushion what we are having on that. So that will help us in maintaining that above NIM of above 3.05%. So you can look at that. Even December we maintained that 3.05, and the March again we have recorded even under the such high volumes of the term deposits which we procured at high cost in the October to December quarter, that still we could manage at 3.07.
Talk to us about recoveries, and it has contributed meaningfully you through FY23. Where should one see FY24 in the medium term?
No, actually, we are given our that just look at that our gross NPA and net NPA in absolute numbers as well as in the percentage. The fourth quarter has seen a visible improvement in that. The first 9 months absolute numbers we could reduce it around approximately 5,500 crores. But whereas in the fourth quarter itself we have reduced 4,000 crores. That has given us comfort to reduce that the gross NPA from 5.89 to 5.35%. The same thing in the net NPA also. Net NPA itself in absolute numbers, in the first 9 months we could reduce 2,600 crores, whereas in the fourth quarter itself we reduced almost again 1,600 crores. That has helped us in reducing that 1.96 to 1.73. Anyhow, our provision coverage ratio of whatever our call that every quarter at least we should ensure that 100 basis points improvement in that PCR has continued, and it has given us a comfort of 87.31%. We have given our guidance in the last our investors slides. There we are clearly told that our gross NPA this financial year we want to bring it to around 4.5%. This is a conservatively we are taken, but we are confident of showing much better results.
Mr. Raju, hi. Let's get a sense from you from the MSME growth, because that has been slow for FY23. Any more stress that you're anticipating?
We have reviewed our area-wise products. All brought it that modifications and made it a market competitive. The second one is our existing travel or processing, the small ticket size, everything has been digitized, and now it is a rule-based engine only. Through them, they can do these things. One is you can ensure the underwriting standards. Second one, you can address the TAT. And with our, we have also further strengthened our 163 SME Sulabs. And there is a special focus has been given to them for encouraging that individual, that Sulab should create that area a dominant product. We are working on that, and they are taking several initiatives. And even the last 1 quarter, I have seen that our total sanctions of these SME Sulabs have crossed more than 10,000 crores. That's the jump what we are getting it. Partly we have dispersed it. The remaining partly we are dispersing in the current quarter. And again, this quarter also we are expecting that these Sulabs will come out with a successful sanctions of more than 10,000 crores. That's the way we want to grow, sir. But this time, definitely we want to grow at more than 8%. But we would like to see that the 10% growth in that MSME sector.
Yes, indeed, 10% growth is the aim. And finally, you've been newly appointed as the MD and CEO for the next 3 years. So what is the outlook in terms of the key metrics? Where would you like to see credit costs, ROAs, NPA ratios, etc.?
Actually, that's we had a recently, fortunately, we had a board strategy meet, and thoroughly this was discussed 2 days, and we have freezed certain numbers for next 3 years. That numbers, few numbers I can share it, because still it is at the freezing stage, because we have to discuss with our field functionaries, circles and regional heads before freezing that. And especially certain where there's a gross NPA, it should be below 3%, net NPA below, it should be below 1%. These are all the standard things. What we have taken is the return on equity should be more than 20%, and the return on average asset should be always, it's more than 1%. These are all the actually the many such initiatives have been taken. Once we have freezed that in the our internally, then we will share with you, sir. But we look at that. The growth rate will continue at a double digit for the next 3 years in the business as well as in the credit.
All right, now, appreciate your time, Mr. Raju, and thank you for joining us. Now, what do we have? We've got a nice little rally in some of the real estate stocks. We've got a nice little rally in delivery. In fact, if I think about it, we've stopped talking about delivery. Why? It also is an internet company. Too much of attention has been suddenly occupied by Paytm, by Zomato, by Policy Bazaar. Delivery's done rather well for itself, actually. It's let's see where it is. That's Nifty. I'm talking about delivery. That's a company which went public about a year and a half ago. The stock price as we speak, I think, is at 380 rupees. That's a delivery for you. It's done rather well for itself from the recent low, but it's a much more stable business, because as e-commerce, now the point is that delivery gets a lot of business from Amazon. What am I talking about? ONDC.
Yeah.
It gets a lot of business from Flipkart.
Yeah.
Delivery, will it continue to get that kind of in business if ONDC and these micro cohorts are essentially implemented? We should get the management actually talk about it.
Let's see, which way things actually head and who stands to benefit from this war which is going on with all online platform services. But for now, let's talk about earnings. Amara Raja Batteries. Vikramaditya Gurneni joins in on the show right now, the ED at Amara Raja. Mr. Gurneni, great to have you on the show. Firstly, we understand that you're planning to invest about 9,500 crore rupees for this factory over 10 years. What could be the outflow over the next couple of years, and how is it that you're planning to fund this kind of a large capex?
Thanks. First of all, thank you for having me. I think phase one, what we look at over the next 24 months or so, consists of a couple of different facilities that we're trying to construct. The first facility that would come up is a commercial pilot plant that we broke ground for just 2 days back, as well as a 2 gigawatt hour of manufacturing. And we're also building in another location, a world-class engineering center, just actually start to do all of our R&D activities in the fast pace. All of this would be about close to 2,000 crores of expenditure. And on this, we're pretty comfortable that totally through internal accruals and internal cash, we want to fund phase one. The rest of the 9,500 crores, I think capital structuring is being planned. It's not that we've immediately allocated resources for that, but we're quite confident that between our cash flows and the ability to raise debt, being a debt-free company, we'll be able to manage these fund flows.
Right. How much dependency on exports will you have in manufacturing a single battery pack, and how much localization of the product are you targeting eventually?
When we talk about localization, I think on day one, when we start manufacturing, we'll be hovering somewhere around a quarter. 25% may come from domestic value addition. So we'll be quite dependent on imports of raw materials for the foreseeable future. But I think a good goal we try to look at is over a period of 5 years that we'll have to look at trying to reach about 60% domestic value addition. Now, we haven't exactly been able to map that entirely because I think it's always been a bit of a chicken and an egg. Do the cell manufacturers, come in and make the first investments? Do the upstream raw material suppliers like cathode, anode do so? So I think right now the cell manufacturers have been more proactive in setting up. But ultimately, whatever, for every dollar we are investing in capex for cell manufacturing, other players will have to invest 3 to 4 times that to make the critical raw materials that we require. But we're looking at hopefully in 5 years, 60% plus will be coming from domestic value addition.
There's a parallel here, the solar power. The solar power prices 5 years ago were at 15 rupees per unit. But because of innovation and because of superior technology, they've come down to 3 rupees a unit. Do you see a similar factor which could be at play when it comes to battery cell manufacturing, that prices will just collapse by 60, 70, 80%, even 90% in the next 3-4 years?
Well, I think that is a good parallel, and that's kind of the trend that battery technology was showing over the past several years. But have we seen, in the last 2 years especially, the battery prices having actually increased, solar prices have also increased. We believe this may be more or less short-lived because there's even recently we saw more and more reserves being found of critical materials. I think the more we look for these materials, the more we'll find. As long as the raw material costs and the supply maintain relatively robust growth in line with demand for battery cells, I think we can continue to see some pretty healthy discounting over a period of time.
R&D, do you think you need to constantly keep on investing in order to keep up to the technological revolution and to really keep up with competition?
Absolutely. I think lithium-ion technology, despite being, maybe a couple of decades old, it's in a very evolutionary phase right now. And every day we see not only new innovations coming in lithium technology, but many new battery chemistries coming to the forefront that may eventually be able to replace it for certain applications. So I think the reason that we're actually putting a significant investment upfront in building an R&D engineering center, filling it with talent, is because we understand that we're doing this for the first time with most of the world. So we need to keep ahead. We need to make sure that we also maintain some technology edge. So this will be a constant investment that we have to start budgeting in every single year.
If the real bonanza what we've hit as a country in terms of the lithium reserves, first in Jammu and Kashmir and then in Rajasthan, how much of a game changer that could be for Amara Raja, for the industry and for the entire country?
I think that's a great way to break it down. I think as a company, what we look at is we look at it very, cautiously and optimistically. We're very upbeat on it, but at the same time, with our plans through 2028, we know we're not really factoring these finds right now because there's a lot that has to still happen. I think discovering reserves, and then making sure we actually find out how to profitably extract them, it takes some time. But as a citizen and what does it mean for the country? I think we should be very upbeat on this because eventually the lithium and other metals are something that we're going to continue to be very dependent on sources. I think Chinese specifically, but other countries as well, they're going very proactively on it. So if this is actually something that can create a competitive edge in the medium term, long term, I think this is something that can augur very well for the country. Of course, lithium is not the only metal that we need to be looking for. There's other critical metals as well that like nickel, cobalt, in case you go for NMC chemistry. And hopefully we can find a way to corner some resources of those as well.
How is the competitive landscape changing? I distinctly remember that Amara Raja and Exide were the two companies which were claiming that, guys, we got the R&D. We know how to move from, let's say, a lead manufacturing battery to a lithium manufacturing battery. But guess what? In last 3 years, 15 companies are claiming the same. Is this entire battery manufacturing landscape becoming almost like the kind of competitive environment we saw when internet started and when the dot-com mania started. You get the sense of my question. I just get a sense that it's getting too competitive. It's no longer a technology moat. It's too simple. Too many companies are claiming that they have the technology. Is it true?
I think maybe because so many companies are interested in it, we're underestimating the depth of technology required to make this type of battery. I think even as a lead acid battery player, we're finding that there's a lot more complexity and a lot of, I think it's significantly more difficult and it's significantly more sensitive process as well. With that said, I don't think that it's going to be, the traditional two players, Amara and Exide, that are alone going to be competing for this market. I think many players, both domestically and globally, have announced their interest, possibly because of other markets like Europe, the United States, China. Larger global players haven't really shown as keen of an interest in India at this point in time. But in the domestic players, I think we have to keep in mind, it's not that everybody has technology readily available. Technology takes some time to develop and a lot of effort. But it's also equally true that just because you have technology, you won't be able to scale it up and create large-scale, efficient, optimal manufacturing ecosystems. So I think there, Amara definitely has its benefits and its advantages. I think we've proven over many decades that we can create world-class manufacturing ecosystems. But I'm looking that I definitely feel that we'll have a lot of new competition, new faces that will be, giving us competition for many years to come.
What is your product mix, and where do you see your products mix changing in 3 to 5 years? And at what tipping point you would say that I'm making more lithium batteries and less of traditional lead batteries?
Well, we have not mapped an exact year. I think the revenue growth in lithium will happen much faster than it ever happened in lead. I think simply put, the cost of the battery is significantly higher. So while we make today, batteries of lead acid batteries in the millions of units, each car only has a single battery, and it's much smaller in value. Whereas each pack that we sell in lithium will be significantly higher. So I think the revenue growth will happen at a much faster pace. I don't know exactly where they'll, intersect and lithium will start to cross. But I think I also want to kind of take a minute to say that it's not that right now all of the growth of lithium will come on at the expense of our lead acid battery business. In fact, India is a very unique case where even though we're going to make significant investments behind electrification of mobility, we're still a country that has significantly lower in car penetration to begin with, compared to even many parts of the developing world. So I think each year there's still going to be some pretty healthy growth, robust growth, even on the IC engine vehicles. And we're going to have to continue to expand our capacities and expand our product offering in that segment as well. So really for another 10 to 15 years, I doubt the lead acid battery business itself will plateau in this country at least.
But if lithium is a high margin and a better return on equity business, why would you be investing in the traditional battery manufacturing capacity?
I wouldn't say that today that we've made a conclusion that lithium is a higher margin business. I think until there's enough domestic sources for raw materials and other things that fall into place, in fact, we would continue to feel that the lead acid battery, especially the aftermarket business, would continue to be, significantly more profitable and attractive. It's more that there's also a pace of growth that we're looking at lithium. I think light mobility, local mobility is where you're going to see the fastest adoption. Your two-wheelers, your three-wheelers, your commercial light vehicles, delivery fleets. Other segments such as longer range mobility, passenger vehicles, I think it'll take some time. Even by 2030, the most aggressive estimates are showing more like 10 to 20%. And it'll take time for that industry to really scale up.
Okay. Appreciate your time. So glad that you could join us, and certainly hope to see much more of you going forward.
Thank you so much.
Let's take a break. Markets are in fine fettle, 61,936. That's the Sensex for you. But equally important is that what we are less than 300 points. That's not even 3% away for the Nifty. Time to perhaps start the countdown and start mapping that if markets will make a new high. I don't think it's going to happen in a jiffy. Traditionally, new highs are not taken out with this kind of an ease. You need a lot of gusto. You may just be nearing an all-time high. While I'll reserve that, reserve my thoughts on when we will make a new all-time high. But for the moment, you're watching the screen. It's the 9th day of a straight line gain for Indian markets.
Back with the market, right 180 now, while of course it's Mankind which is the buzzer of the day. It's a solid 20% premium that the share has listed at. So great debut over there. But right now you're also seeing very big moves on an IGL, on MGL after a strong number, and Birlasoft as well, which is reacting to its numbers. So let's welcome on board Angan Guha, the CEO at Birlasoft, joining in on the show right now. Angan, great to have you on the show. You managed to report a bounce back in Q4, much unlike the trend from some of the large cap IT majors. But tell me, going forward, given the impact of Invacare, what's the outlook for FY24?
So first of all, thank you for having me on the show. We don't give an outlook for the year, really. I mean, we don't give a guidance, but suffice to say that we had a great quarter. Outside of Invacare, we were able to deliver 3% sequential growth, which, I think was a very strong execution-led quarter. Going forward, we will continue to focus on execution and see how the future quarters look like. So right now, it's all about execution going forward.
You delivered 16% revenue growth in FY23. Will it at least be a double digit in FY24, and is 3% quarterly run rate then possible?
So, Aisha, it's a little hard to say in terms of how the markets are going to move. As you know, there's a huge macroeconomic headwind that we are facing. And it is really difficult to predict the future. But for now, I can only tell you that, we are focused on the business. We are making our investments in capabilities in the verticals that we have called out. And I'm confident that, we will continue to execute well. Now, whether it will be a double-digit growth or not, only time will tell. But we are taking one quarter at a time.
What you're telling us is that right now, given that the IT industry is going through a cyclical downturn, you don't see any large problem whatsoever, at least at Birlasoft.
So, Nikunj, as I see today, right, I don't think we see any problems with any of our accounts or clients at this point in time. But that is, again, what we see today. Again, like I was saying, it's hard to predict tomorrow. But today, the accounts that we serve, the clients that we serve, are pretty strong.
Isn't that, while it's quite commendable, but isn't that extraordinary that your peers, whether it is big or small, tiny or micro, all of them are giving us a different commentary? They're feeling the heat.
Yeah, look, Nikunj, even we are seeing the market's headwind. It's not that we are not seeing the headwind. The headwind is there. The question then becomes the kind of clients that you serve and how your clients' spending pattern looks like going forward. From our perspective, we are a relatively small business, roughly about $600 million a year. We had a good quarter, and we will be focused on execution. And we will take one quarter at a time because it's hard to predict the future, like I said.
Just wanted to understand a little bit further then, Angan. When it comes to Invacare, is the issue then fully settled, or you think there could be some more adjustments on account of that?
No, Aisha, we have completely provided for everything in Invacare. As you know, last quarter, we almost provided about $19 million, about 153 crores. And that's the provision that we have taken, and that's our final provision. There are no more surprises. We've reached a settlement with Invacare, as we have declared to the stock exchanges. So that is what it is right now.
At a time when the industry per se is going through a cyclical downturn, what happens to the future business? Could that come under pressure because the competitive intensity will increase? Suddenly, medium-sized companies and large-sized companies will start reconsidering the deals, because right now it is a buyer's market, not a seller's market.
Yeah, so in many ways, we are seeing two or three different things, Nikunj. One is clearly there is a pricing pressure in the market because, like you said, there are headwinds, and our clients are facing the headwinds as well. But second, we are also seeing the deals shifting from more transformation deals to cost takeout deals. So the deals are happening. In fact, our pipeline is only improving, and our pipeline probably has been the highest it's ever been. The question is whether the clients take decisions or the decisions get pushed out. So deals are happening. The issue is, how quickly can we convert those deals into deal wins?
How do you see FY24 then being different from FY23? A simple and a point blank question.
It will be different. It will absolutely be different. I think FY24 will be very different than FY23 because of the headwinds that we see. And there will be pressure both in terms of revenue growth as well as margin uptick for sure.
Okay, can you define that for us?
Sorry, I couldn't hear
No,
that question. Can you repeat that question?
Can you define what is the meaning of headwinds? Maybe in a numeric number or maybe giving an example so that we can understand it.
Yeah. So, Nikunj, if you look at the different sectors that we serve, so let's take financial services. You're seeing what is happening in the financial services institutions globally, where there is a pressure in terms of their balance sheet as well. And as a result, from all the discretionary spend that was happening earlier, now the spend is more going towards a cost takeout. If you look at the manufacturing companies, though they are investing continuously in their business, but their revenue growth is under pressure. So in many ways, various industries are facing various pressures at this point in time, and that will ultimately have a big concern in terms of how they spend on IT. So we'll have to wait and watch how things shape up. Which is why, I keep saying we will always take one quarter at a time.
So let's talk about the current quarter. And right now what we understand here is that US regional banks are going through intense pressure. You've stated in the past, when I looked at your previous comments, which has been shared by various brokerages, that you don't have a direct exposure per se to a regional bank. But what are the chances that, given that there is a shakeout which is happening, directly, indirectly, your business could get impacted with a lag effect, something which you don't know today, but it could hit you rather?
And it is very possible, Nikunj, because, first of all, we don't directly serve any mid-tier bank in the US. We serve some, clients related to payments, brokerages, clients who are big in the housing market, etc. Now, there could be a lag effect based on how the banking sector moves. But my view is, our financial services business is way too small. It's roughly about, give or take, 130 million out of the 600 million. Now, if you compare it to our larger peers who've got billions of dollars of exposure to the financial services market, our business is way too small. So, in fact, quite contrary, I'm very bullish on the financial services market. Given our exposure to that market, our financial services business will continue to grow.
I wanted to also understand a little more perspective in terms of the margin exit rate, what the numbers could be like. For the end of FY24, the guidance is about 15 to 16%. Are you on track?
Yeah, I think we should be on track on that one. From a margin perspective, as you know, for the immediate quarter, we will still have to serve Invacare till the end of May. And after May, of course, we exit out of the Invacare contract, which will give us a margin uplift. So I can't really give you an exact guidance for the quarter, but suffice to say, by the time we exit this financial year, I'm pretty confident that by 4Q FY24, we should be in that 16% EBITDA level.
Okay, appreciate your time. Thank you for joining in and giving us more clarity on the quarterly earnings. Mankind Pharma, we just saw the listing taking place and it has been pretty much on expected lines, pretty healthy listing as well that we saw for it, currently quoting above the 1300 mark, given that, Nikunj, we were just talking about earlier this morning, decent listing gains was expected, very strong domestic business, and looks like the street is taking credence to that.
Like we were discussing that this is the listing of the season, and it's good. Why? Because now markets are saying that India-focused companies. See, it's an India-focused business.
Yeah.
That's the differentiating factor. 90% plus business comes from India. What is the definition of a big Indian pharma company? 35% comes from India, 35% comes from the US market, remaining comes from the semi-generic market. That I think is the differentiating factor here. In India, the growth is high. It's almost like a double-digit growth. In India, you don't have too many pricing power across the board now, especially, and the pricing controls are only there in some qualified drugs which come under the drug control, which come under the drug control umbrella, so to speak. For Mankind, I think the chronic business is going. The ROS and the margins are strong. It's a listing where markets, in a sense, have not been very happy with the way how some of the pharma companies have had earning volatility. So here's a company which is a domestic play, gives you a play on complete visibility of earnings, decent, decent return ratios, and then you got a huge 3 to 5 year opportunity where you know that the chronic care segment in India is only going to increase as the per capita increases. I think it is still at a discount to MNC companies, but I will not be surprised that if a company like Mankind Pharma sooner than later actually starts commanding P multiples which are much above the traditional pharma sector, and it is closer to the MNC pharma companies. It will settle somewhere in between, above the traditional Indian pharma company and below the MNC pharma company. That's my sense. Anuj Jain joins us now. Let's connect with him and we'll talk numbers, shift sectors from Mankind Pharma to the paint industry. Anuj, good morning. Thank you for joining us. Have you looked at your stock before you joined us? Should I share the good news with you?
Yes, I've seen.
Do you think the market reaction is justified because markets are saying worst is behind the paint industry, worst is behind Kansai Nerolac, and they will stand tall to the competition which is coming from the Birlas and the Jindals?
You know better about the market, but I can say yes, the quarter, in fact, all our businesses, as we have been working and we have been talking about in the last few quarters, that we have our strategy, we are working to support all our businesses. And in this quarter, all businesses have grown well. So to that extent, the result was good.
The gains. Now let's talk about the top line. How much of the top line is because of volume and how much is because of value?
So it's volume and value basically matters when it comes to the decorative business. So decorative business, there is a double-digit value, volume, both are kind of equal growth. And even other businesses, the value growth is better in case of industrial, and volume growth is a little lower. But decorative volume growth is also double-digit.
Mr. Jain, hi, morning. You have seen input prices as well that have softened. In light of this, what is the outlook on your overall margin trajectory, given that you have already seen a smart margin expansion, YOY?
Yeah, so it's a combination of one, that there is some softening of the input prices, but still the weighted inflation is still positive, but the prices are cooling off. And then there are some internal initiatives. So margins have been, we have seen some expansion, and there is definitely a possibility of margin improvement going forward also. But we also have some initiatives where we are investing, because these are long-term, medium-term initiatives, and we are investing behind these initiatives so that we are able to respond. Like, the question was asked that how do you respond to the competition? I think we have to enhance our ability, and to that extent, we are making certain investment in the strategic areas.
So can you just put a number to that? Will it normalize to pre-COVID levels of 17 to 18%, and by when?
Difficult to comment on the numbers. I can only say that possibility of improvement from here on. And as I said, that the gross margins will definitely improve. Whether the gross margins equally will reflect into EBITDA margin, yes, but partly. As we said that we are committed to certain investment into our strategic areas, and we are definitely working to execute those strategic initiatives. So to that extent, our investment in the top line, the growth initiative will also be there.
How much of the raw material benefits you are likely to pass on, and how much are you likely to retain?
As of now, as I said, this weighted inflation is still positive. So there's no question of as of now passing on. It's not the right time. So whenever the right time we reach to, because typically what happens is that in the decorative market, when this prices goes up, then we are able to pass it on to the market. But in industrial, there's a lag period. So similarly, when the prices cool off, there will again be a lag period. So it's not the right time. I think when the right time comes, we'll take an appropriate decision.
Numbers from Dabur, they're struggling because rural demand is not there. I look at the numbers which are coming from, let's say, Nestle, they are growing because urban demand is strong. What are the factors at play if I have to compare rural versus urban demand for Kansai?
So we are relatively stronger in the rural market, you can say, and quarter on quarter we have seen some improvement in the rural demand. It is still, we can say that urban demand is better, but there is a uptick in the rural demand if we look at quarter on quarter basis. When it comes to the urban demand, I think the institutional business, the project business, the premium categories have been doing well, and our initiatives in terms of launching some of the innovative products under Paint Plus, increasing our outreach to the influencers, have been there in the urban market, and there we are seeing some, that these initiatives are gathering the momentum, and it is working for us.
So how do you see financial year FY24 moving differently from FY23? Because FY23, the general sense was that it was not a great Diwali or Dussehra or a Christmas season. Do you see somewhere impact of high inflation, high raw material pricing, everything will normalize and 24 will be a significantly better year then?
In terms of top line, if we talk about Diwali, because I think this year Diwali is in the month of November, and typically we have seen whenever Diwali is in the month of November, paint industry gets a better result. Reason being because the monsoon get extended every year till say late September or October. So last year Diwali was in the month of October, so the second quarter got impacted. So there may be a better response in this year because Diwali is in the month of November. Overall for the year, I think that paint industry is directly have a good correlation with the GDP growth. So if GDP growth is expected to be around 6%, I think the industry growth would be in the range of 8 to 10% in this year.
Your demand, is it coming from fresh construction? Is it coming from repainting? Where is the demand coming from?
Coming from both sides. So fresh construction contribute around 12 to 15% to the total business. So in the fresh construction, the demand is slightly better. So we can say that in the repainting, the demand is 8 to 10%. The fresh construction, the demand is around 15 to 20%. So that's the difference. But the contribution of this new construction is about 15%.
Last question. If I look at the current construct of the paint industry, there is one large player with more than 50% market share. Then there are 4 players who in between them have about 40% market share. 2 new players are going to be coming in the market soon. How do you see this entire dynamics of the paint industry changing? Because the Jindals are trying to disrupt and Birlas are committed to change the dynamics. How do you see the dynamics changing in 2 years, 3 years, 4 years, 5 years?
See, it is good for the industry, good for the consumers, that more number of players in the industry. So to that extent, it is definitely a welcoming step for the industry and for the consumers. It may increase the competitive intensity, that's a different issue. But if you see in paint, the penetration is still about 50 to 55%. And obviously, the existing players, they do a lot of communication, advertising to basically increase the awareness. And over a period of time, we have seen that the penetration is going up. But with the good players coming in the industry and more number of good players will be there. And when they also participate, I think the penetration of the industry will go up. And therefore, there is expected that, the industry growth also will go up. The second is the formalization of this, because in the paint industry, still 25 to 30% come from the informal sector. And there also we have seen gradually there is a shift to the formal, which probably will further escalate, when these players will come in. And we can see a lot of innovation because paint traditionally has been about color and finish, but I think there's a lot of technology, functionality, so many new products and the cost efficiencies one will be able to see, and to that extent will be good for the market.
Thank you for joining in and giving us a clear picture. This has clearly been a buzzing stock, so I'm sure that the street was very keen to hear all of the commentary that you had. That's the view coming in, double-digit growth in volume and value in the decor business, and right back.